But this area here is where you would anticipate on Fridays where liquidity could be a draw, because it's going to likely pull back up into a premium. What does that mean? Here's 8:30. Here's the turning point at the 9:30 rotation. So this high, or we could use this high here, it doesn't make a difference, but I'm going to use this one because we're framing the logic behind this day being bearish. So this high down to the target, if you put a Fibonacci on this low to high and find the 50% level, this is above 50%. So that means above here, that's a premium. So the market's going to move from what? A discount to a premium. That's what the market does. That's the algorithm does. It seeks discount to premium, premium to discount. Within that logic, the market is reaching for liquidity in the form of buy stops and sell stops, and or imbalances, or the creation of an imbalance, fair value gaps, or returning back to a fair value gap. Okay, that's all these algorithms do, and they do it on the basis of time, then price. Now, that's a gross oversimplification by me, but by far and large, that's all these things do. It's not your buying and selling pressure, okay? It's not the effects of the DOM, okay? I got a lot of people asking me because they watched me show things in my live account, and they think I trade with the DOM. I don't trade with the DOM, okay? I'm not looking at the DOM, trying to read how many orders are resting above or below, because there's spoofing that goes on. And those orders may not be there when the price goes there. So I don't think that the DOM is something that is useful. I'm only throwing that in here because I saw a lot of people in the comments asking about those types of things, and I don't use them. I don't use them in my trading, and I don't think there's anything in terms of advantage in using it. If you believe you're being profitable because you are, don't let my comment change your mind. And I'm not trying to open up a dialogue for debate, because you're never going to convince me. Okay, so you're okay if you're using it, but I'm answering students or viewers, and that's my opinion. Okay, so I'm not trying to begin a debate about it. Okay, so we have a PM session buy side liquidity pool that the market could likely reach up into, and again, the logic is we moved from this high down to a target. It's Friday. There's probably going to be position squaring. They're going to want to take the market back higher. So what are they going to reach for as an opposing move? Notice what I'm saying here. This was the target. There's going to be short covering. Who's short covering? The smart money that sold short here, 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 and here. So if they're covering a short, are they bearish still? No. So if they're not bearish, what are they? Bullish. So if they're going to be smart money and buy down here, or if they're going to use this imbalance in here, if it trades down into that, you can see a run higher. If they're going to buy it, what are they going to target? The buy stops up here, and they're going to sell right to those buy stops. They're buying this and selling it to these waiting buyers on their buy stops. Notice these relative equal lows. They take it into the order block right below those relative equal lows, because it sells what? It sells the retail crowd that this was support broken. What are they going to want to do? When it trades back up into these relative equal lows, they're going to do what? Sell, right? That creates more liquidity for buying. So this is engineering buy side liquidity on the basis of sell side flow. Sellers coming in the marketplace. These sellers, they're going to have a counterparty in the form of smart money buying it. They want to sell short because they see relative equal lows breaking. The trend's been down. Everything looks bearish to them because it's been going down all day long. So they think naturally it's going to keep going down, when it's only traded down to where the algorithm says this is what we wanted. And now we're going to reprice higher. We're going to move from a discount to a premium. The premium intraday is going to be this area here. And that's going to be where the market draws to for the afternoon session buy side liquidity. All right, I was going to do the pause the video type thing here, but this is going to be a long video, so I'm just going to go right into it. All right, so we have a mitigation block here, and I teach that in the YouTube channel. But we have market structure breaking. We come back down into the mitigation block, and we also have the imbalance, fair value gap there. So we can be a buyer here. And remember, the 45.32 to 45.40 level. Go back up to this chart here. Right in here. So this high, right here to here. Think about those price ranges. We trade up into it here. So buying here and aiming for that liquidity up here, that would be your target from buying to getting out there. Selling to those waiting buy stops. The next one is here. The market trades down in. And I counsel you to go into your chart. I left this out for your own personal study. But if you look to the left, go over here, you'll see an old high. Okay, old highs are a discount array. If you trade above an old high, that old high becomes a discount array. This is where, not all the time, but this is where old highs being broken become support. That's why sometimes the books have it right. That's why sometimes your analysis will be right about specific key highs and lows. But notice they're not always consistent, and that's the problem. So you want to know what makes a old high or an old low real support or resistance when you have the logic what I'm framing here, because we know that the likelihood of the market's going to draw up into this area here because that's where the buy stops are resting above the marketplace when it hit the order block down here. So what we're saying is the market's going to bounce from here up into this vicinity here. So if the market comes back down in and touches, it could have touched this high here, but there's an old high to the left over here. You'll see it. It trades down and hits that, and it also fills in an imbalance. When you have that, old highs broken will act as support. So there's something for your notes. Then we have the run up into that area. So it's not a bad little run. Now, once we get up into that shaded pink area, what have we done? We fulfilled buy side liquidity in this area here, but we have a little bit more later on, which obviously you can see it runs to, but here we see it do a run lower. So we break below a swing low, market structure shifts. Is there any imbalances in here? No, but there is one right there. See that? Here's your fair value gap, shift in market structure there, retraces back up into the fair value gap. You can be a seller there and aim for this low or the order block. Or you can wait for a confirmation entry, which is we turn here after it hits that fair value gap, breaks lower, and then we have another break in the structure of the marketplace on the 1 minute chart. Creates the imbalance here, fair value gap, trades up. Yes, it overshoots it, but we also have two fair value gaps. Remember the rules I gave you? If you have a fair value gap and a smaller one right above it, anticipate it likely trading up into you, but use this as your entry. Go short here, and then aim for the order block.